Hello and welcome to Fintech Insider Insights. I'm David Barton-Grimley, Strategy Director right here at 11FS. And in this episode, we'll be discussing the crisis that has gripped banking as a service for much of 2024, which has taken down players in the market which were once considered absolutely unsinkable. So BaaS is something that just keeps coming up in news time and time again over the last few years. So we thought we'd do a bit of a deep dive for all of you listeners out there. In this episode, we're going to be investigating how BaaS went from the fintech wunderkind of 2023, as the rest of the sector languished, to, in some senses, the disgraced black sheep of the fintech family. Might be controversial, but let's have the discussion. And I'm joined by a panel of BaaS experts to properly pick all of this apart. So it should be a really interesting one today. First up, welcome back to Fintech Insider for Jason Mikula, founder of Fintech Business Weekly. Always great to do a pod together, Jason. And you've been chronicling the BaaS crisis and the falls of Evolve and Synaptics for several months now, which we're going to be talking about a little bit. And I hear you've got a book coming out all about BaaS.
I do. So somehow I managed to complete writing a book in the first half of this year, and it will publish and be available in December. So folks can find that on Amazon or wherever they buy books. I do also have a new title. I recently joined next-gen decision platform Tactile as head of industry strategy for banking and fintech. Thus, I have the obligatory disclosure that all opinions are my own and don't necessarily reflect the point of view of any companies that I work with.
Amazing. Lots going on, Jason. Yeah, looking forward to reading that book. And next up, it's a Fintech Insider debut for Nicolas Benady, CEO of Swan. Welcome to the pod, Nicolas. Can you tell us a little bit about the work you've been doing at Swan?
Hello. I was starting to think I might have to sneak myself onto the show. So for years now, I've met my team listen to 11FS to learn about fintech. So I'm really glad to finally be here myself. So even if today we are diving into what's wrong with BaaS. So what is Swan? So Swan, we are a BaaS. We are a banking as a service platform. So at Swan, we build and sell banking services, similar to what Revolut, Monzo, or Conto offer. But no one is going to download the Swan app. And that's because we work behind the scenes, white label. So other companies can offer banking services under their own brand. Whether it's expense card, insurance, or meal vouchers, we helping other to open accounts, generate IBANs, issue MasterCards, and process payments. So thanks to Swan, thanks to a simple integration, there are more than 130 European companies who offer banking services to their clients, right within their own product. And today we process over €1 billion in payment every month. We are a fully regulated financial institution ourselves. And for the fintech nerds out there, yes, we have our own ledger. We are connected to MasterCard. We handle reconciliation in-house. So that's one of the clients we get excited about. It's not only future neobanks, not those who wants to compete with Revolut. Rather, what's really exciting is when existing companies, existing products embed banking services to make life easier to their customers, to build better experiences. So it could be in HR tech, travel tech, insurance, you name it. And so, of course, in turn, this happens to be a model that creates a lot of new revenue streams for companies that do it. So it's attractive for everyone. And I think it's safe to say that today Swan has unlocked the embedded finance market in the European Union because we built a very simple product and we made it genuinely easy to implement.
Awesome. Great to have you here, Nicolas. And finally, we have a return to the podcast for Susan French, BaaS and payments consultant. It's great to have you back on the pod, Susan. Can you tell us a little bit about what you've been up to since you were last on the show?
Well, after the wind down of BBVA Open Platform, which was my last full-time job, I've been working as an independent consultant in the BaaS space, as I'm an evangelist for the subject, and I truly believe in the potential of embedded finance. So I work with both fintechs and enterprises that want to add financial services to their customers' benefit and need to understand what that means in terms of what they need to do and who they need to do it with. I also work with some banks that are interested in becoming partners in the space and also need to understand what they need to do and how they need to do it in order to be successful. I don't work with the current slate of BaaS intermediaries much, but I have worked a bit with a few of them in the US as well.
Awesome. Great to have you back. Okay, right. So let's go into it. And in the first segment, we're going to talk about what went so wrong for a bit of background context. So to kick off the show, we'll take a look at the crisis that no one in the industry really saw coming as two major banking as a service players crashed and caused violent ripples for the broader fintech sector. So I think before we do this, it might be actually worth taking a bit of a step back and asking ourselves, like, what exactly is BaaS? Where does it come from? I mean, I've been working in this industry for almost 20 years now, and I can't actually remember. I can't pinpoint, like, when was the exact moment where a bank or a fintech decided, hey, I'm gonna offer my services out as a SaaS type platform. Susan, I'm going to come to you first. I mean, when did this first appear on your radar?
Well, the first time I was actively involved with banking, with financial services as a service, was at Visa when I led the team that developed Visa Developer, which delivers Visa network and card processing services via APIs through a developer platform. And I think that was, at the time, this was 2014, a fairly revolutionary concept for a company like Visa. But BaaS, as we talk about it, was something I learned a lot about when I moved from Visa to BBVA and took on the responsibility of leading the product and client operations team for the creation of Open Platform, which was BBVA USA's banking as a service platform. I will take a minute to get on my pedestal and make a semantic point about the distinction between embedded finance and banking as a service.
Yep.
Embedded finance is what enterprises and businesses do in order to provide financial services to their customers, employees, merchants, suppliers, whomever their audience is, through their user experience. Banking as a service is the combination of technology, process, people, and licenses that are necessary in order for a business to do embedded finance. And while sometimes that combination of things is all offered by a bank, most of the time, in the US anyway, it's offered by a combination of a technology provider platform company in conjunction with a partner bank. And they split the responsibilities for those services between them. And I think, to the point you started the conversation with, it's how that split happens that has led to some of the problems we've seen in the industry of late.
You're right. They're kind of distinct business models, but they overlap in some pretty important ways. That resonates with me. I mean, I remember BBVA were definitely one of the leaders back in the day. Jason, I want to come to you. When did the problems begin to start? What were that sort of very first sort of seeds, like, there's a problem here?
So I would actually dispute the characterization that nobody saw this coming, in the sense that more than 2 years ago, I wrote a piece discussing some of the risks of the structure in the US that leverages FBO accounts, or for the benefit of accounts, including the challenges of doing BSA AML compliance and reconciliation with those types of accounts. So I don't think it's right to say nobody saw this coming. As far as the proximate issues of the sort of crisis, as you put it, that's continuing to unfold. Synapse and Evolve are kind of ground zero for that. I think people would probably date this to Synapse's bankruptcy, which Synapse filed for bankruptcy in late April. And when a proposed deal to have Synapse's assets acquired by another fintech company called TabaPay fell through, Synapse was in this Chapter 11 bankruptcy, and allegedly Evolve froze, or functionally froze, all accounts and money movement around or on May 11th in response to Synapse revoking access to its internal systems that are referred to as the dashboard. There have been some anecdotal stories or evidence that end users may have lost access to funds or the ability to move funds a little bit earlier than that. But in reality, I would actually date sort of the broader industry tumult to 2022, right? I mean, that's when we saw the first let's say the first recent consent order of the sort of current cycle against Blue Ridge in late 2022. We've, of course, seen a bunch of consent orders against U.S. banks since then. There have been some similar challenges in other markets. Railser, UK-based Railser, of course, filing for bankruptcy. Railser's EU entity also having money laundering issues. So, the Synapse Evolve story, I think, certainly is the most severe and catastrophic situation, particularly because end customers lost access to their funds. And in fact, we're here in September, and still some end users do not have access to their funds.
Wow.
And that's May, June, July, like 3-4 months already. So yeah, I mean, understandably that has driven a lot of attention, but I think some of the underlying causes, there are some, similarities or some issues that generalize to other banks and other middleware platforms, but there are also some, idiosyncratic, specific things that I think Synapse and Evolve, may have done wrong that contributed to the situation they find themselves in.
It's really interesting. And, I also hear that since then Evolve has had some pretty major problems with cybersecurity. I mean, maybe that as an example, or elsewhere, are you seeing any other kind of seeds of issues with other types of providers as well?
Yeah, so, and I imagine we'll unpack this more, and I'm certainly curious to hear Nicolas's point of view, given the fundamentally different structure of how what we're sort of generally referring to as BaaS or embedded banking, fundamentally different structure in the European market and the UK market, as well as other jurisdictions around the world that have other kinds of licenses, specifically the EMI license, or some people might talk about a fintech license or a payment license, but basically a non-bank, non-depository license, which does not, you could quibble about MTLs, but basically does not exist in the US market. I think some of the challenges that we've seen in the Synapse and Evolve case around reconciliation, it would not surprise me if other banks, other fintech programs in the US market may have similar challenges. The reason why we've learned about those problems at Synapse and Evolve is because they needed to give people's money back, and they couldn't.
Yeah, absolutely. Nicolas, just to Jason's point, let's go to you. How do you reflect on this?
Yeah, so I totally agree with what Jason have just said. For me, it's not a BaaS problem. It's a fintech problem. It's a bank problem. So any bank, any fintech can have an issue with its ledger. So it can happen to fintech. It can even happen to a bank. For me, it's like a plane crash, So, and as I understand, the way BaaS is designed in the US is very particular, with software on one side and sponsor bank on the other side. And I think, yes, it's much safer in Europe, in UK, where the financial institution and the software is merged. It's just one company and not two. So if you look at the European BaaS players, Solaris, Railser, Modular, Griffin, Swan, we are all regulated financial institutions. But you know what? I think that the Synapse Evolve mess doesn't come from this separation. So great companies are doing BaaS in the US, like Unit. So I strongly believe that the Synapse Evolve mess is not a problem with the design of BaaS. It's just like a plane crash that's making people look in the wrong direction. Because yes, there is something that is very challenging with BaaS, but it's not ledger, it's not reconciliation. For me, the challenge of BaaS is that the distribution of financial services is done by companies that don't know enough about banking. This is an indirect distribution channel. So banks and fintechs usually they have a direct distribution channel, direct-to-consumer approach, if you want. They build financial services and they distribute financial services through a branch or through an app. And BaaS builds the same products than banks, accounts, cards, IBANs for payments. So, and they build Ledger and they are connected to MasterCard. It's exactly the same. The only difference is the distribution channel again. So you could think of the clients as distributors, but this is risky because the clients of BaaS themselves are not regulated. They're not expert. So if you think about authentication, KYC, this is complex and this is risky, especially in terms of anti-money laundering. And I don't want to name and shame competitors, but many European platforms have had some issues with their regulator. They probably gave too much power to their customers, maybe not realizing how risky it was.
I mean, I would add just very briefly that part of what we've seen in the US is the offloading of bank responsibilities, bank regulatory obligations to third parties that are, to Nicolas's point, not themselves directly regulated. That doesn't mean that they can't try to carry out those obligations on behalf of the bank. Using the unit example that Nicolas gave, can't speak to the ledgering and reconciliation because there's nothing public about that. But plenty of units customers have had issues with potential UDAP violations or improperly claiming FDIC deposit insurance without the legally required proximate and conspicuous disclaimers about who the underlying insured depository institution is. Again, that doesn't mean that that their technology doesn't work or the model is inherently unworkable, but ultimately those obligations belong to the bank. If the bank is contracting with unit, with another company, with a customer-facing fintech, and they fail to meet those obligations, the responsibility ultimately lies with the bank, full stop. At least in the US market as it's constructed currently.
Yeah, that's true. I mean, one of the most detailed discussions I have with my bank clients who are thinking about becoming partners in BaaS is the need for them to understand what they're going to have to step up to the plate and do, and what that means in terms of both dedication of staff resources to due diligence, compliance, regulatory monitoring, as well as marketing and other understanding how to understand the fintech business so that when they're faced with the prospect of a new client, they know how to evaluate them, both in terms of their business model, their stability, their future prospects, and all of that. Typically, most banks in the US, especially the small community banks that are major participants in the BaaS ecosystem, don't know how to do. Yeah. And so there's, I think one of the things you're going to see more of in the future, I, for one, don't think embedded finance is dead by any means, but I do believe that there will be some restructuring of the way banking as a service is delivered in the US in order to enable that. But what that means is that banks that want to be partners are not going to be able to just kind of quickly top into Unit or TP or Synctera or any of these other guys and start seeing the deposits roll in. They're going to have to be much more strategically thoughtful about what it means to be in the business. And they're going to need to think about whether or not it's time, core modernization or not, to step up to the implementation of their own technology or the acquisition of technology they can control.
And we're already seeing that repositioning, Susan, to your point,
Absolutely.
Unit, Treasury Prime, Synctera, who I think are kind of like the three probably most substantial, I don't even know what to call them. The new regulatory term is intermediate platform providers, have sort of repositioned, and now they're saying we sell software to banks, which I think is a logical and appropriate response to the regulatory environment.
Yeah, and then there are companies like Infinite, for example, who have started to do that deliberately to build white labelable platforms so the bank can basically operate as if it had invested in building its own technology without having to do so. I honestly think that's the future of embedded finance.
Mm-hmm. A sector is re-evolving or reassembling in a completely different way. I also feel like the sense of what is embedded finance has matured massively since, even since 2022. Some of those use cases, particularly on the B2B side, are just so interesting and so compelling from a kind of, profit potential, fee income potential point of view, which I think we're gonna talk about a little bit more in the second part of the show. I just want to unpick a little bit about the kind of investor excitement about BaaS back in 2023, and you, Jason, saying like, actually, hello, I was talking about it, people were talking about it. Like, why does this keep happening with fintech, where you get these huge bubbles, this big excitement, big sort of company valuations, but some of the fundamentals just don't seem to have been in place, particularly around, all of you have been talking about a lack of skills or a lack of understanding on how the financial system works on the part of some fintechs. Like, why was there a kind of a wholesale failure really to predict this? I mean, it's not just fintech, right? This happens in all sorts of different sectors.
No, I mean, that was actually going to be my first comment, that the sort of bubble-ish nature is certainly not specific to fintech. I mean, I think in venture-backed ecosystems where you see one company start to gain traction, you tend to see a lot of copycats offering similar things, right? I mean, something we didn't talk about at the top and probably don't have time. The idea of banks partnering with non-bank companies isn't new in the US. It dates at least to the late 90s in prepaid programs and in so-called rent-a-charter for powering, in that case, it was payday loans to get around state usury law. So like that model's not new. What we did see change quite dramatically, and I believe Synapse was the first to sort of pursue this model. Synapse was founded in 2014, was the idea of basically trying to abstract away having to deal with the bank, right? If you think about the sort of prototypical Silicon Valley founder or software engineer, very different mindset than bankers who, I've spent enough time in my career around, tend to have a much more risk-focused and risk management-focused frame of mind versus the sort of cliche move fast and break things ethos of Silicon Valley. There are a whole other slew of factors, including just like the glut of VC money, a decade plus of very low or 0% interest rates pushing more money into the VC ecosystem. Of course, the 2020 pandemic, when the line of thinking at the time was, oh, the future has been pulled forward. Everyone is going to use e-com, shopping online for everything. So there were a lot of factors that went into that sort of bubbly feeling in fintech broadly and in BaaS specifically. And I think that part of what that enabled, and I've got to give credit to Jason Henricks of Alloy Labs, was the idea of tourists or people building in the financial space who maybe didn't have much experience in the financial space. To use Synapse as an example, that company was founded by a team of people that had not only zero financial services experience, they had zero work experience. It was founded by, I don't know if they were still students at the time, but Sankeet, who is the co-founder, and his colleagues were in their early 20s at the University of Memphis. How they got a bank to sign on to that still to this day confounds me. A young team with minimal funding and zero experience in banking, basically having access to basically run, I don't want to use the word shadow bank, that's a bit pejorative, but have a substantial amount of authority delegated to them by their bank partners when they had no demonstrable experience in any of this stuff, ledgering, BSA AML compliance, consumer, UDAP, marketing compliance, none of it.
Yeah. It turns out that this is a highly regulated sector. Go on, Nicolas.
Yeah, Jason, they tried to build a core banking system, actually. So every functions you've talked about is what is normally a core banking system. And in order to build this, you need some experience. And so when you're talking about banks buying software to do embedded finance, actually it's just banks using a secondary core banking system to do some to distribute banking services in another way.
I think Synapse had the benefit of being the pioneer in this space. They had the bright, clever new idea that no, but really, I don't think anybody else at that point in time had tried. And they were able to show some intermediate term successes before, things started to go awry. And so they had the benefit of the halo effect at the time of being, a smart young fintech with a great new idea that nobody tried before, and that had, at least on the surface of it, significant profit potential for the banks that participated.
Suzanne, I can't let you say that it was the first banking as a service platform ever. I've been in the fintech industry for almost 20 years now, and I've seen some banking as a service platform, even if the term wasn't coined. There were some things like that in Europe in 2008. So companies that don't exist
qualify
anymore.
that by saying in the US, then that's
probably.
No, absolutely. I mean, look, this is classic, right? You get a bunch of very young people, mostly outside of the industry, going, hey, we're going to abstract some complexity here. I love that thought, Jason, by the way. And then you lift the hood in and it's like, oh, actually, this is a highly regulated sector. There's all sorts of things we didn't understand. But, I suppose, Susan, to your point, credit is due, to the way that, you can move fast and break things. But then when the things do break, the pieces get reassembled into better things. And that segues quite nicely into the next part of the podcast. But before we get there, we're going to take a quick pause here before we discuss how BaaS can get back on track. So it's all coming up after this super quick break, so don't go anywhere.
Are you struggling to close deals? B2B selling is tougher than ever, and that's why we want to tell you about LinkedIn Sales Navigator. LinkedIn's Sales Navigator is a sales intelligence platform that helps professionals effectively prospect and engage high-value customers, drive higher revenue, and increase sales performance. Sales Navigator helps you target the right buyers, surface key signals such as job changes or which accounts you should prioritize, and shows you hidden allies so you can find those buyers who are most likely to convert. Fueled by LinkedIn's 1 billion member platform, Sales Navigator gives you the most up-to-date first-party data, enabling you to unlock conversations with the people who matter. Right now, you can try LinkedIn Sales Navigator and get a 60-day free trial at linkedin.com/fintechinsider. That is linkedin.com/fintechinsider for a 60-day free trial. Let LinkedIn Sales Navigator help you sell like a superstar today. Just go to linkedin.com/fintechinsider and get started.
Ryan Reynolds here for, I guess, my 100th Mint commercial. No, don't. I mean, honestly, when I started this, I thought I only have to do like 4 of these. I mean, it's unlimited premium wireless for $15 a month. How are there still people paying 2 or 3 times that much? I'm sorry, I shouldn't be victim blaming here. Give it a try at mintmobile.com/save. Whenever you're ready.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See details.
Welcome back to Fintech Insider Insights, where this week we're looking at banking as a service crisis that has rocked fintech. And in this segment, as I said before the break, we're going to be talking about reassembling those building blocks into the future and what's new. And speaking of the future, Nicolas, I think it's only appropriate to come to you. We've been talking about some of the failures. I'd like to know from your perspective as CEO of growing embedded banking, embedded finance firm, how hopeful are you about the rebound of BaaS?
Well, first, I don't think there is really a crisis for BaaS in Europe. It's totally different than what we have witnessed 18 months ago with the SVB bankruptcy. There is, of course, a huge noise probably in America and in the fintech ecosystem. But we hesitated to communicate about it because, we have 130 clients in Europe and only 2 of them asked us some news about this issue. So I don't think it's really something big again in the European Union. But so your question, how hopeful am I about rebounding? I'm not thinking about rebranding because BaaS works. We are talking about some issues that small startups have, but think of Adyen, think of Stripe. Stripe issues million of cards. It just works. Nobody talks about it because it's not interesting to talk about things that works, but it does work. That's it.
Yeah. So you're basically looking at the market into the future and saying, actually, there is pretty huge growth here. There's going to be a growing need for embedded finance. Is there anything that you're taking forward? I mean, I certainly know regulators in the EU are thinking more about this topic. Are there any particular learnings you think which would change the business model, or how you go to market in the future in the EU based on what has happened or just what the regulators are doing?
Honestly, we won't take any lesson about what happened with Synapse and Evolve. It's not relevant to us. I think I've already talked about the challenges that come with BaaS, and I'm not saying that BaaS is not something challenging. It's risky. It's hard to build, and you can build technology to solve these challenges, but it's not about ledgering reconciliations. So if your question is how can we keep clients safe without stifling innovation, there are many solutions. And I think EMIs is a great answer. So we often talk, in 11FS about PSD2, PSD3, but I believe that the biggest revolution is PSD1, the one that allowed lighter kinds of financial institutions in Europe. Without them, no Wise, no Revolut, no Adyen. And this regulation has inspired many countries. Like you have some EMIs in Singapore, Malaysia. Maybe the US should try.
It's a good challenge. I mean, Jason, do you see structural change happening in the US that would enable something like an EMI?
No.
I got to take that as
sorry. No. I mean, I think particularly having experience living, here in the European Union, and of course, continuing to work and travel quite frequently to the US, I do think from a public policy standpoint, the idea of something that is comparable to an EMI license, I think is the right direction to go. Right now, what you have is basically banks functionally being deputized to act as the regulatory overseers of these non-bank fintechs, right? And that model, I think, not just Synapse, but there have been plenty of other examples, again, particularly on sort of like the marketing UDAP side, where it's easier to observe as an external stakeholder. This model is not fit for purpose. Not having a direct relationship between the customer-facing entity and the regulators, where the regulators have the ability to go in and supervise those entities, I think, is a major contributor to the problems we saw at Synapse and with other players, in the space. However, at least it's my understanding that to create some kind of whatever we want to call it, fintech license, payment license. You'll also recall that in the United States, to more easily lend on a nationwide basis, you also need to partner with a chartered bank, although state-level charters are available for lending that wouldn't require a bank partnership. But to create such charters, I understand would require an act of Congress. I mean, certainly now, whatever, 2-3 months out from an election, there's about 0% chance of that happening. Depending, I don't want to turn this into a political talk show, but depending on what happens in November, could substantially impact the likelihood of some kind of national non-depository charter. Acting Comptroller of the Currency, Michael Hsu, has expressed some support for the idea. I think he phrases it as like a national money transmission license, MTL, which is not exactly the same thing, but like kind of close. But no, I am not holding my breath for some sort of U.S. e-money license. I don't think it's in the cards, particularly because your incumbents, the banks, stand to lose dramatically if that were to happen. Banks, 4,000 plus banks, another 4,000 or 5,000 credit unions, very powerful political constituency that will defend the benefits that come with having a charter. Creating something like an EMI license would could potentially substantially reduce the attractiveness of holding an economic value of holding those charters.
Hey, Jason, that's exactly to avoid this kind of monopoly that the European Union decided to create new competitors to banks, and it worked.
Yeah, one of the benefits of the EU is the central regulatory authority. One of the challenges of doing BaaS or embedded finance in the US is, 50 plus different jurisdictions that have control over what you can and can't do, where you can and can't do it. Having personally gone through the process of obtaining a bank charter, I can tell you that is not an easy thing to do and takes a long time. And I think I agree with Jason. I think the probability of there being any kind of federal or national regulatory framework like that is nil. I think what we're going to have to depend on in order for BaaS to become resurgent again is for there to be, the fintechs of the world and the enterprises of the world that want to do embedded finance are going to have to also step up to the plate in order to do that, in order to become more responsible players. And the banks are going to have to take on more responsibility for providing oversight than they have been. They heard the Swan song in the early days of BaaS. The Swan song, no, that's not the right word.
It would be otherwise.
The siren song in the early days of how easy it was to sign up to be a partner bank. You don't have to do anything. You just get to see the deposits roll in. Well, I mean, the crises of the last year have taught them that that's not the case. Doesn't mean that economics of being in banking as a service are not there. It doesn't mean that demand for embedded finance is declining. In fact, the opposite is happening. It just means that in order to be a player, you're going to have to belly up to the bar with more money, just fund staff, process, and potentially technology in order for that to work for you.
So Susan, just sticking with you, what would you say those propositional changes are that are happening in the US if you assume the economic value is absolutely there and growing? What does the future of the BaaS business model look like in the US?
My personal opinion is that those banks that are serious about BaaS are going to start moving toward a direct fintech model where they either build their own technology like we did at BBVA, or they partner with a, intermediary platform that is white labeled, contains their content. They control all the parameters. They define all the products. They review all of the output of the KYC and KYB. They review all the results of the transaction monitoring activity. I believe that's the future. Not only that, but then they get to keep more of the money too, which makes it a lot more attractive option. And so I think there's a future for BaaS providers who are willing to white label their presence to sell to the banks rather than to the fintechs. The banks that want to play that, though, are going to have to step up and staff for not only all of their regulatory and compliance responsibilities and have people, watching those dashboards all the time for the KYC results and acting upon them appropriately. They're going to have to learn how to do due diligence of the fintechs and enterprises that want to do embedded finance, and they're going to have to learn how to sell. One of the biggest challenges I have with the banks I talk to is they haven't got a clue how to sell embedded finance to not only just to fintech startups as we typically think of it, but enterprises that want to embed financial services for the benefit of their employees or for the benefit of their suppliers or whatever the case might be. And they're going to have to learn how to do that.
No, so, Susan makes a great point. I think it's difficult to underestimate just the chasm of cultural difference between a lot of these small banks that play in what we're calling the BaaS space, which many times are in, Evolve is in West Memphis, Arkansas. A lot of them are in like Tennessee, Virginia. They don't tend to necessarily be in New York and San Francisco, but a lot of, the fintechs or the large corporate enterprises that may want to partner with them, tend to be more sort of like coastal technology forward companies, and sort of the skill set not only of being able to sell to those institutions, but then actually build a partnership and operating model. It is a real challenge. In the one other bit I will add is there's almost certainly going to be some kind of new regulation that comes out of the Synapse disaster, right? We've seen 3 of the 4 major federal regulators, so Michael Su at OCC, Rohit Chopra at CFPB, and outgoing FDIC Chair Martin Gruenberg specifically mentioned Synapse in their public remarks. Like they're signaling very, very clearly, we are paying attention to this. And concurrently, they've also issued a request for information on bank fintech partnerships. So every signal suggests, again, subject to what happens in November, that there will be some kind of regulation, proposed rule that comes out of the Synapse disaster.
The point that both of you are making about the customer being so fundamentally different, digital businesses are just have very, very specific requirements that you're right. To this day, banks really struggle to understand, how do we serve a customer who's interested in APIs, that wants to fully integrate a very complex financial, product into a very complex digital journey. So, Nicolas, I want to come to you. And talk a little bit about the future of the customer needs that you're seeing coming from BaaS. Like what is that? How are the needs of your customers evolving over the time? What are the kind of things that they're demanding for?
So there is something that I do agree with what you said, and something I don't agree. We are not serving complex financial products or complex financial services. We are serving very basic banking features. So we're just talking about, payment cards, transfers, IBANs. So the kind of thing that everybody knows, that my mother knows how to use. But transforming this into APIs is not easy. This is a complex part. So I do agree with what you said. It's not easy to transfer this simple product into APIs, and the complexity is security risk, because yes, we want to keep a direct relationship with our end user. But if I come back to your questions, what are the future of the needs that we see with our clients? We see that many financial management softwares want embedded finance, at least in the European Union. So accounting softwares, billing softwares. We also see that PropTech, so property management softwares, they want embedded finance, insurance, and all of them, they want the same. They just want the basic services sold by banks, which again are accounts, cards, IBAN, sometimes payment acceptance, and yes, probably credit in the longer run as well. So that's it.
Yeah. And I suppose, it's great to hear, a lot of positivity coming from an EU perspective. And one of the things that we're also not talking about, I think, on this podcast is the Middle East and Asia. And I think someone on the panel mentioned EMI regs in I think it was you, Nicolas, and, places like Malaysia and Singapore and Dubai is doing a lot of stuff there as well. And, Saudi are just coming through the open bank regs, and it'll be very interesting to see how other geographies learn from some of the things that have happened in the US and in the EU. I guess I guess there's almost like a full circle here we can kind of end on. And I think it was Susan, it was you who mentioned that, in the US, a lot of the future could lie in banks actually doing this themselves. And if you take maybe like a 15, 20-year view and you start off with BaaS almost began, which is, let's take the Synapse example, a bunch of young people going like, how does this not work? This doesn't make any sense. We can abstract this complexity and just do this ourselves because banks can't build this software. And then you fast forward, banks mature a little bit more. They begin to understand what an API actually is and how it works and how to re-engineer their core to make it happen. And then you fast forward to 2024 and into the 2030s. And actually banks are now, well, actually, I have some cloud infrastructure here. I can do some of this myself. You're seeing some of the much bigger, like global banks, like JP Morgan, for example, Goldman Sachs, and all of these kind of companies begin to reorient their business models around technology. And so is there an argument where you say you actually end up at the beginning where there is a kind of a future where to be a successful bank in the future means that you do need to be tech-enabled to some degree. And that could be an incumbent bank. It could be a new financial institution, like Swan, for example. And in some ways, it almost doesn't matter. Is that the kind of future we're moving towards, maybe?
So I have an opinion on that. I think it will be very, very difficult for incumbents to build banking as a service platform, to build APIs. It sounds easy when you start. And then it comes with so many complexity that we're happy that we don't serve customers directly. We couldn't do both things at the same time. So I believe that, of course, there will still be banks serving directly their customers, and probably 80% of the financial services will be served directly. But I believe that there will be dedicated companies like Swan, but not only us, like Stripe, Adyen, and these companies will offer banking services with an indirect distribution channels. And the technology you have to put behind this is much more complicated than what banks probably have in mind. So I strongly believe that there will be some dedicated companies for that.
I mean, I tend to agree in parts and disagree in parts with Nicolas's assessment. The U.S. market is always just a bizarre outlier for so many reasons, right? And if you look at some of the underlying forces that have pushed particularly the smallest community banks to play in this space, part of the problem is that there are just too many banks in the United States, right? And what used to be important, the geographic footprint that they serve through their branches, has become dramatically less important in the past 20, 30 years with the rise of internet and then mobile banking, right? And so for those institutions, BaaS, embedded banking, embedded finance is a lifeline in the sense that they need those deposits that Susan was talking about to exist and to continue to operate as a bank. At the other end of the spectrum, huge banks like JP Morgan Chase, which invest something like $17 billion on its tech stack in a single year, I think it's naive to think that they're not going to be able to play somewhere in this space. It may not be a customer-facing app like a neobank. There's a lot of reasons why that wouldn't make sense, particularly given JP Morgan Chase is subject to Durbin Amendment, so interchange income isn't there. The deposit, Chase doesn't need the deposits. So you're going to see sorting and segmentation based on the capabilities on the bank side and what the bank needs, whether it's a sub 10 billion community bank or a huge bank like JPMC, or regionals that play in the payment space like Fifth Third, which has its new line offering, which is kind of like embedded BaaS in that area, as well as some of the regionals like Citizens and KeyBank. And then I think I heard Nicolas make this point. You're also going to have newer entrants that are maybe tech native. So in the U.S. market, that would be Column, Lead Bank, maybe Grasshopper, Piermont to a certain extent. And in the UK EU market, players like Solaris, Griffin, which are fully licensed banks, as well as Swan, which is an EMI. So what happens is going to be very market dependent and, take into account who are the existing players and where's the opportunity going forward.
So interesting. Susan, I want to come to you for the final word.
Yeah, I agree. Part of the reasons why banking as a service grew as rapidly as it did is the small community banks that Jason was mentioning saw it as an opportunity to stay alive. When you've run out of opportunities to grow customers in your geography or in your industry specialization, for example, if you're an oil and gas bank, where do you go? You either find another source of customers or you get gobbled up by somebody else, which is part of the reason why, we've seen the number of banks in the US drop dramatically in the last 10 years. But I also believe that given what the whole Synapse debacle and everything else related to that has brought focus to the risks associated with being a partner bank and the cost of being a partner bank effectively and under appropriate regulatory control is going to drive some of those little guys away. So I think the future is going to be focused more on the regionals and kind of middle tier bank providers who see this as an opportunity for them to create a competitive advantage vis-a-vis the big guys who, as Jason correctly noted, don't need to play in the BaaS space to grow, and the little guys who can't afford it.
So interesting. And on that note, that wraps up today's discussion. Thank you so much, all three of you, for joining me today. Where can people find out more about you all? Jason, start with you.
I'm still on Twitter for some reason, so folks can find me there or on LinkedIn and subscribe to the newsletter, which they can find at fintechbusinessweekly.com.
Awesome. Nicolas?
You can just Google swan.io or Swan BaaS, but you can find me on LinkedIn.
Amazing. Susan?
Yeah, you can find me on LinkedIn. You can also find me on Twitter, although I don't spend as much time there anymore as I used to.
And I'm completely off Twitter, actually, or should I say X.
Good for you.
Yeah.
Good for you.
I just can't be bothered anymore with it. And you can find me just on LinkedIn at David BG. Thanks for listening. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. Thanks very much and goodbye.